Yesterday, when the Fed made its trend-setting rate decision, Jerome Powell pretty clearly emphasized that the bar to cut rates has become higher. It's a prospect that our next guest warned about last summer. Remember, we entered this year expecting 6 to 7 rate cuts. Now, thanks to Jerome Powell's statements and the economic data, the market's really only pricing in one, maybe at the end of the year. Let's bring in Andrew Slimmon. He is Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management. So, Andrew, your comments last summer were very prescient at a time that we were all high on the prospect that rate cuts were definitely coming this year. Now we're not so sure. What does that crystal ball look like for the next year?
Well, I think that was, I'm very fortunate, but I think really what helped me and my team was really listening to companies. And we're a portfolio management team. We attend a lot of conferences and talk to companies. And what we heard across the board was a lot of economic strength throughout all sectors. And so it really led us to believe, number one, that, kind of last year at this time, the market was kind of weak. We thought it would rally in the fourth quarter because earnings were going to come through. And that's really been the story. And so, yes, on the one hand, it's unfortunate the Fed, it'd be nice to cut to bring rates down. So rate sensitive assets are struggling. On the other hand, what they're really saying, and it's true last summer, is the economy is strong enough to allow us to be more patient. And so to me, that validates earnings estimates for this year and to start next year, close to $280 for the S&P. That's a very important number as you think about where the market will end this year, is that earnings estimate. As long as the Fed doesn't suddenly shift and say the economy is really weakening, that's good news for earnings.
Earnings generally, especially in those big tech names, have been delivering over and above expectations. But I'm wondering since you do pore over the statements and the tone, if you are detecting maybe even the hint of a slowdown, with some of these consumer names like a McDonald's or a Starbucks, they seem to be winning only on price, right? Consumers do seem to be, particularly in the U.S., starting to get a little bit more price sensitive.
Without a doubt. But tech is one thing. The consumer, I don't think the consumer is slowing down. I think the consumer is becoming more price sensitive. So companies that have been aggressive price takers, I think it's coming back to haunt them. But I hear other companies, and that are, maybe more experiential companies, they're doing just fine. And then you mentioned tech. I don't see a slowdown there. CapEx spending continues to be strong. And then there's other areas of the market that are benefiting from fiscal policy spending that are certainly benefiting right now. But there's no question, you're right. The consumer is becoming a little bit more circumspect in terms of paying the prices that they were willing to pay a couple of years ago.
And so for an investor, maybe the instinct is to get defensive. If you look at April, the only two sectors that were even a little higher were the utilities and consumer staples, while tech was one of the worst. Would you follow that trend, or will you look to take advantage of some of that weakness?
Yeah, so look, I mentioned the 280 number is really key as I think about year end. Market's trading at 19, 20 times. So if I fast forward to the end of the year, that forward estimate is going to be 280, unless estimates go down or estimates go up. And so at 1920, that kind of gets you to the mid 5,000s on the S&P, but the market almost hit 5,300 in March. And so I don't think there was a lot of upside kind of from March until year end. But now with the market pulling back to almost 5,000, it actually dipped below at one point, I think there's more upside. So at the end of the day, what scares me, worries me, is when companies that we own say, hey, business isn't good, bring down your numbers, et cetera. because I've learned in this business that there's rarely one bad quarter. And yes, the consumer, I heard some weakness in consumer, but overall didn't hear that. So I think the setup is actually better after this little April retrenchment. I think there's a bigger kind of drawdown coming this summer, maybe more like the 10%, but I suspect we're largely behind this April weakness because you have the Fed saying, not to worry about the next step will be rates lower, and we've had a good first quarter earnings season.
So with that in mind, you're a stock picker. Give us some high conviction ideas that you're comfortable owning here.
Yeah. So look, first of all, as I mentioned, follow fiscal policy. We are spending a tremendous amount of money by the U.S. government right now via the Infrastructure CHIPS Act and Inflation Reduction Act. And oh, by the way, if you look at every time a president runs for reelection, you would have to go back to 1940 to find a year when the market wasn't up. And it's up on average about 16%. Why is that? Because presidents know that to get reelected, they have to have the economy humming. And the way they do that is through fiscal policy spending. And this is exactly what we're seeing this year. So following the spending by the government, infrastructure, that is building roads and bridges and so forth. And so a company like United Rentals, which rents out heavy equipment, that's a beneficiary. CRH is a cement company. That's a beneficiary. Moving to the CHIPS Act, right? We're building semiconductor plants in the United States to attempt to not be so dependent on foreign manufacturers. So a company like Applied Materials that makes semiconductor equipment, they should benefit. And then I think the other area that I scratch my head and I'm in amazement is the amount of money that's gone into money markets. Currently, money markets have about $6 trillion in them. It's the fastest growing asset over the last year. It's up about $1 trillion. And you say, well, why is people pouring money into money markets? Well, they're doing that because 2 years ago, money markets were yielding 0.5%, and now they're yielding 5%. So they look really attractive. The flaw in that logic is everyone's looking at the nominal yield, 5%, but they're forgetting by the fact that inflation is up, very substantial. And that's what they measure. You and I know it's even higher for us. So the real yields on money market are not particularly attractive, but I think that money will find its way into other assets eventually, equities, stock, bonds, and so forth. So I like the wealth management stocks like an Ameriprise, a wealth management advisory firm. I like those types of stocks.